All right, guys, another reaction video. We're doing this from NYU finance professor Aswath Damodaran. I think I'm pronouncing that right. We'll see. I don't watch many videos, so I've not seen this video yet, but I really respect Aswath very, very much. He's a smart man. I recommend watching his videos about valuation and business. Very smart. So let's see what he has to say.
Interest rates are rising and many analysts predict an earnings recession, yet stock valuations are above historical averages.
That is
so
true.
We're asking the Dean of Valuation, NYU finance professor Aswath Damodaran, to explain what's going on. Thanks so much for coming on the show, Aswath. It's great to have you back.
Oh, thank you for having me.
So let's start with the broader market. You know, for years, bulls were justifying higher than average stock valuations by saying, well, bond yields are so low. Now, that's not true anymore, right. And some say that earnings may be going down from here, not up. So does 18 times earnings make sense right now?
No, I think you need to step back. At the start of this year, I said there were two forces that would drive what markets do this year. One was inflation and the pathway it takes to either becoming benign or staying malignant, and the other was what will happen to the economy. They're going to drive what the market does. And I think the question of whether we're going to pay 18 times earnings or 15 times earnings or 12 times earnings will largely be determined by whether inflation stays at 5% or drops to 2%.
Let's take a company that is sort of in the middle, I guess, would be Tesla. That valuation obviously skyrocketed, then it plummeted. Now it's up nicely over the past few months. How do you go about valuing a company like Tesla?
I think, from my perspective, it's an automobile company that has a tech component to it. So you got to give Tesla credit. They've reinvented the automobile business. They brought everybody else to play the game that they're playing. And in the process, they're creating a new story for an automobile company. Now, I know that Cathie Wood thinks that automated driving can double the price. I don't see the market for that.
So bottom line, it sounds as if you think that valuation is still a little high on Tesla.
This is a stock where I'll never get it right. I'll overshoot, I'll undershoot. I'm willing to buy Tesla at the right price. I think it is a special company. I don't think...
So, I like what he's saying here in the sense of he's being a little evasive, because he's on TV. He doesn't want to sit there and say what I want to say, which is, yeah, I ain't touching it at this price. But whenever you do a valuation, and he's the person I learned this from, it's a story. What is the story about the company? Now, the one thing I like about what he said is it's an automobile company with a tech component. And unlike Cathie Wood, he's not willing to sit there and apply a much higher multiple merely because of self-driving. Google's been doing self-driving and working on it for 20 years now. I had friends in college who were on the Google team for figuring out self-driving back in 2004, 2005. Okay, this is not something new. However, the technology for it is getting better and better and better. And that's okay, but it's possible to overpay for a good thing. And at the end of the day, Tesla's still a car business, and they're still going to end up having the car business issues if they want to continue doing things in the United States. There's still going to be unions at some point that have high costs that are going to affect the business. And the car business in general is not a very easy business to be in. High cost of capital, a lot of capital needed to sustain and continue to grow. That's very difficult for companies to make really good value for investors. Go look at Ford, go look at GM, go look at Chrysler, go look at all these companies that at some point. Now, one car business I am very interested in, Ferrari. But even Ferrari with its higher margin, 50% gross margin and 20% bottom line margin, and a good return on invested capital, it's possible to overpay for that as well. But those are the car companies I want to focus on, the luxury ones, the ones that have an absolute dedicated group of people who would do anything to have them. So what he's saying here is every company, it's about a story. And he is right that inflation is going to dictate a lot. Why is inflation going to dictate a lot about valuations? Well, if inflation jumps up, what does the government have to do to fight inflation? They're going to raise interest rates. And right now, the 90-day Treasury is currently at 4.8%. Hypothetically, let's say the 90-day Treasury went to 10%. What would happen to stock prices? They'd have to fall because our risk-free rate is 10%. So why would I go invest in the stock market hoping to make 10% when the government's willing to give me 10% a year just by investing in a 90-day Treasury? And the higher inflation goes, the way to fight it is increasing rates. If the 10-year Treasury, which is currently around 4%, went to 10% itself, why would I invest in the stock market when I can get 10% from the US government for 10 years? 10 years! That's exactly what we're talking about here. But when interest rates were 0%, temporarily, people thought, nope, this is a reason I'm going to keep buying it. When I say temporarily, It could be 5, 10 years of the kind of interest rate. But you got to look at decades and decades of interest rates. I remember when I first started buying real estate in 2003, a real estate agent said to me, well, Paul, we haven't seen historical averages of 12 or 15% interest rates. And I remember just like saying, what? They said, well, yeah, when I started in this business, interest rates were 15%. I'm like, yeah, you started in 1980. Of course, interest rates were at 15% in 1980. But the historical average for the 10-year treasury is about 4.5%. We're at 4% right now. Okay, we're still below the historical average. Now, the median, I believe, is 4.4. Okay, so we're still below the median. Let's continue on with Aswath.
It is the greatest company ever to walk the face of the earth, as some of its true believers think it is. But I think it's a special company. I gave them a valuation of around $400 billion. But the way this company is priced right now, it's priced even higher. Market sees something that I don't. And until I can get some clarity on what that additional stuff is, I'm not willing to pay the premium.
And you mentioned Cathie Wood, so let's go there.
But I do like what he's saying there. He's like, listen, I valued it at $400 billion. The market's valuing it higher. I don't see it. So until I do see it, I got to stick with this. And that's the point of being an investor. It's okay to pass. It's okay to say, you know what? I don't get this. And when new information arises, your view of that investment should change. As new information arises, it actually matters, right? For example, XYZ Corporation is making $1 billion a year for the rest of the time, and you know that to be true. It's going to happen. Then all of a sudden, something comes out, and XYZ Corporation has a patent on the next biggest valuation, the next biggest business that's going to add $2 billion to the company's profit starting 5 years from now. Should you pay more for the company? Absolutely. Information's changed. The information has absolutely changed, and you should change according to it. But what ends up happening is a lot of people will take every small piece of minute data and try to say, oh, this is confirmation bias, or this is whatever it is. It's like, no, some data just doesn't matter. And some data does matter. At the end of the day, I look at Tesla and I go, okay, their gross margin is better than most car companies. Their profit margin has been better. Okay, great. But they're being valued as if the higher valuations than even the gross and net profit margin of Ferrari. Yeah, I don't get that. And I just choose to pass on it. So let's continue on.
Seems to think, correct me if I'm wrong, that innovation will justify almost any valuation.
Well, Cathie Wood's stupid.
What she's buying.
Innovation is not a business, right? Innovation is change. I've seen businesses be innovative and have terrible business models. I mean, remember the 1980s, PCs were the innovation of the day. Out of every 10 PC companies that were started, 8 went out of business. So we often mistake innovation and growth for profits and value. And I think what I find lacking in Cathie Wood's story is she has a good sense for trends and the macro, but her grasp of the micro leaves me gasping of, so how do you run an investment fund without connecting the micro to the macro? So telling me that everybody will buy electric cars, I'm willing to go along. But then telling me that...
And then telling me what?
An individual company will have an 80% market share of all electric cars sold. You got to do your work to establish that 80% market share. So when I look at ARC's recommendations, they're all built on macro stories. You're making macro bets, but without doing the work of connecting.
Yeah, that's brilliant. So what he's basically saying here is, listen, she might be right on innovation, but innovation is not a business. And I always say to people the same thing. Cars were innovative 100 years ago. How many car companies survived? 5? Out of the thousands? Airlines were innovative 100 years ago. How many airlines survived out of the thousands that went? It's very few. You have to be able to say, okay, this is innovative. It's probably too early and too difficult to decide who are the people that are going to last. Look at the 90s. Look at computers. Remember a company called Gateway Computer? Everybody, if you're too young to remember it, go Google Gateway. That was a huge computer company back then. Did you have one? Did you? I didn't have one. I had a Packard Bell. I had a Tandy 1000 RLX. Where are those companies? I think Packard's probably part of the Hewlett-Packard, whatever. But guys, come on. This is ridiculous. Like, Cathie Wood has no understanding of valuation. And I think that's what he's meaning when he's saying the micro level. Like, you have to connect the micro business with the macro idea. Yes, but then you also have to pay the right valuation. So guys, I will say, I love Aswath. I don't agree with everything he's saying. I don't agree with $400 billion in Tesla, but he's a smart man. So when he said that, I kind of go, okay, maybe he's right. When Kathy Wood says it, I go, okay, she's definitely wrong. When Jim Cramer says it, they're definitely wrong because they don't understand valuation. More than the micro, they don't understand the valuation. So guys, if you like this video, one thing to do, subscribe. We do a lot of videos. We do a lot of commentary. So thanks very much. And forward this on to somebody who might need this.